All right, we have a critical market intelligence update for you on silver. Now, this isn't about the day-to-day price swings. This is about a fundamental strategic shift that, according to institutional analysis, is already in its final stages. The story that we've all been told about the silver market for the last 15 years, well, it's about to be turned completely on its head. For over a decade, the narrative was really simple, right? It was the small retail investors, the silver stackers, fighting this big war against the massive paper short positions of banks like JPM. But the new reality, the one that's confirmed by actual warehouse receipts and vault data, is something else entirely. The battle lines have been completely redrawn. It's no longer retail versus the banks. It's now JP Morgan's colossal physical hoard versus the entire global industrial complex. This quote just says it all. The institution everyone thought was so vulnerable to a short squeeze has actually spent the last decade positioning itself to become the squeeze. They haven't been cornered at all. They're the ones who built the corner. So let's take a look at the evidence. We're going to start with the first and maybe the most stunning piece of this whole puzzle: the sheer scale of the physical accumulation that's been going on, pretty much unnoticed by the mainstream. 750 million ounces. That is the size of the physical silver stockpile controlled by just one private entity. To put that in perspective for you, that's over 60% of the entire annual global mine supply, all sitting in one set of vaults. This is, by far, the largest private hoard of physical silver in modern history. So the big question is, how did they acquire it? Well, this timeline shows it wasn't a sudden move. This was a deliberate, long-term strategy. It all started back in 2008, when they picked up Bear Stearns' toxic short position. For a decade, that paper position was allegedly used to keep prices down. And then look at 2015, that $920 million spoofing fine, for placing huge, fake orders to manipulate the market. Well, institutional analysis now frames that as just a business expense, a small cost for acquiring physical silver at artificially cheap prices. And by 2025, the mission was complete. They were net long. Okay, let's move on to the second piece of evidence, because this isn't just a story about a single bank. This is a geopolitical event, and this is where the timeline gets really, really critical. January 1st, 2026. You might want to mark that date down. On that day, China is set to roll out a strict export licensing policy on silver. Now, this isn't a tariff. You have to think of it as a strategic blockade. It's a state-mandated decision to control the flow of a critical industrial metal, and it looks a lot like what they've done in the past with rare earth elements. So why does this matter so much? Well, because as this chart shows, China isn't just some minor player in this market. They refine nearly 2/3 of the world's silver. Their own domestic demand for things like solar panels and electric vehicles is just exploding. By locking down exports, Beijing basically ensures its own industries get fed first, while effectively starving their Western competitors of that refined supply. And here's how these two fronts come together into what analysts are calling the pincer movement. Over in the East, you have a state-mandated supply restriction from the world's biggest refiner. Then, over in the West, you have a private monopoly on the largest available stockpile. The result is a coordinated squeeze on the global physical market, whether it was intentionally coordinated or not. So the crucial question is, who gets caught in the middle of this pincer? It's not the retail speculators anymore. No, the real victims here are the very foundation of our entire modern technological economy. We're talking about the giants, companies like Tesla, which literally cannot build an EV without silver, Apple and Samsung, who need it for every single phone and tablet they make, and even the defense sector, with companies like Raytheon relying on it for critical missile guidance systems. The thing is, for these high-performance applications, there is no substitute for silver's conductivity. And their vulnerability is magnified by this, the just-in-time inventory model. For decades, it was praised for being so efficient, but its greatest weakness, its Achilles heel, is a sudden supply chain shock. These companies don't keep huge stockpiles of raw materials. They just assume they'll be available on the open market exactly when they need them. Well, that assumption is about to be put to the ultimate test. This chart right here reveals just how fragile that assumption is. I mean, look at the bar on the right. The COMEX registered inventory, the so-called stockpile for industrial delivery, is sitting at a historically low 30 million ounces. Now compare that to the bar on the left, the 750 million ounces held in that private hoard. The available open market supply is a rounding error. It looks like a massive wealth transfer is just waiting to happen. So let's pull back and look at the macro endgame here, because this is so much bigger than just one commodity. This is really about the stability of the entire financial system. The institutional analysis projects $100 an ounce, but not as a speculative ceiling, as a new floor. This isn't about a rally. We're talking about a revaluation. It's the price that's required to properly mark to market a decade-long accumulation strategy. Internal models are even said to suggest targets far higher, but $100 is seen as the baseline for this entire reset. So what was the ultimate motivation for all this? Well, this slide lays out the strategic hedge perfectly. On one side, you have over $36 trillion in U.S. sovereign debt, a digital, basically unlimited liability. On the other side, you have a tangible, finite hard asset. This entire maneuver is being interpreted as a massive defensive play, swapping out depreciating fiat currency for a real physical asset to hedge against a potential sovereign debt crisis. And a final warning from this analysis. As that January 1st deadline gets closer, expect extreme volatility. The anticipation is that there will be sharp, engineered price drops, false flags, if you will, designed to shake out the last of the weak hands and create liquidity for some final acquisitions before the true repricing event really takes hold. And that brings us to the final, critical question. When the physical supply of a globally essential finite asset is cornered by both state and private powers, it forces us all to reconsider the very foundation of value. In a world of real, physical scarcity, what is the true worth of a paper promise?